At JPMorgan, every DCF model we built underwent a rigorous sensitivity analysis to test its assumptions. Even small changes in growth rates or maybe discount rates could shift the fair value significantly. In this video, I'll show you how to perform sensitivity analysis in a financial model and explain how these adjustments can actually impact your share price. Let's dive in. Hello friends, welcome to Wall Street Mojo. In today's video, we are going to discuss what is sensitivity analysis and how sensitivity analysis in financial modeling is one of the most important things that you will do as a financial analyst. So first thing first, I would like you to look at this 7 steps to discounted cash flows. So this is a part of that financial modeling. And the first step is all about projections. So you remember what is financial model? Financial model is a place where you have fully understood the historicals of a specific company, say for example Netflix, and then you do the forecast of that, right? So projection would mean you're forecasting the financials of the company. So that's basically step number one when it comes to discounted cash flows. Now, if you look at the last step, we have sensitivity analysis, right? So I'll come to this step, but there are other steps in between which are super important so that you reach this sensitivity analysis, and I'll also explain you why that is important. So once on the basis of projections, you basically try to figure out what the free cash flows of the firm will be in the future, right? So the approach that we typically use to find the fair value using discounted cash flow is that we use the present value concept. We see that how the future cash flows will be starting today, and we discount all the free cash flow and see what is the overall value, right? So we say that this is the fair price of the company overall, right? So that's the logic behind discounted cash flows. But in order to find the present value, what we would also need is a discount rate, right? So the third step involves finding out the discount rate, and in the context of DCF, we call that as WACC, or weighted average cost of capital. Okay. Now, what is terminal value here? The fourth step involves calculating the terminal value. So typically what happens is when you're doing this financial model, you may be doing it for 5 years, 10 years or 15 years or so. But there could be value beyond 15 years. Say, for example, from 16th year onwards until infinite, right? So you'll assume that the company is going to be there forever on a going concern concept basis. And therefore, there will be value beyond the 16th year, after which we have not done any forecast, right? So that value is captured under terminal value. So after we have all this, we find the present value of the cash flows, and we find the present value, the terminal value, to find the overall value of the firm. And after doing some adjustments, we come to the fair price, right? Now, the thing is that when it comes to DCF, it is very sensitive to the assumptions that we use. One of the sensitive assumptions is the discount rate, like the WACC. So weighted average cost of capital could be 5%, 6%, 7%, 8%, 9%. And it can have a massive difference in terms of fair price calculations. So that's why sensitivity analysis becomes super important in the context of financial modeling. So let's go to the Excel sheet and look at the sensitivity analysis in the financial model. So here we have this ABC company where we have been provided with certain set of numbers, including the free cash flow to the firm. So as you know, we are assuming that we have done with the projections, and then we have also calculated the free cash flow to the firm. Okay. So here you see that there is this 2024. These are the historicals, and all of these are projected numbers. Okay. So we have already calculated free cash flow to the firm, and the formula for free cash flow to the firm is very simple. It is operating profit, that is EBIT, 1 minus tax rate, and you add back all the non-cash items like the depreciation and amortization, and also the stock-based compensation if there is any. And you reduce the capital expenditure, and if there are any changes in the working capital that are leading to cash outflows or inflows, you're basically accounting for that as well. So all in all, what we are doing is we have projected the free cash flow to the firm until which year? We have projected until 2024, right? Now, the next thing that we also need to understand is that once the projection is done, we have to find the discount rate, right? So at the end of the day, this is the cash flows that the company is earning until 2044, sorry. And after that, also, there will be free cash flows, but we will account for that in the terminal value. Okay, so Next thing we need is the discount rate. And for the discount rate, we have already done the calculation for you. And, when it comes to the calculation of WACC, or weighted average cost of capital, the formula is very simple. Weighted average cost of capital is equal to the proportion of debt multiplied by cost of debt plus proportion of equity multiplied by cost of equity. Okay, so that's the formula for WACC, or weighted average cost of capital. So in this example, we will not go into the calculations of WACC because we would like to limit ourselves to the sensitivity analysis part of it. But here we have done the complete calculation, and we'll share this Excel sheet with you, the link to which you will find it in the description box below. So do not worry, we have done all the respective calculations for you to understand how WACC is also calculated. Okay, so I'll assume that we have done this. Now, coming to the next step, that once you have the discount rate, you are basically expected to find out the terminal value, right? So, terminal value is the value which you will find after 2024 here, right? So, let's do the terminal value calculation here. What's the formula for terminal value? The formula for terminal value is nothing but your free cash flow to the firm in 2024, in this case, that the last year for which you have done the projection, multiplied by 1 plus G. G is the terminal growth rate. A growth rate at which this company will grow after this year. This divided by WACC minus G. WACC is weighted average cost of capital, which we already calculated, and G is again the terminal growth rate. Okay, so what do we need here is to find out how much is the terminal growth rate. And terminal growth rate, in fact, we have been provided here in this example, and this is 2.5%. Okay, so we will use this 2.5% here to calculate the terminal value, or TV. Okay, so I'll do it here. This will be equal to, this is the free cash flow to the firm, right? This multiplied by 1 plus G. G is your 2.5% divided by, what's your WACC? WACC is 9.31 here, minus G. So I put that formula here and found out the terminal value. Okay, so this is your terminal value, and you will have to now use this terminal value for subsequent calculations. Okay, so when it comes to DCF, we are done with FCFF, we are done with WACC calculation, we are done with terminal value calculation. The next step is basically to find out the present value. Okay, now there are two types of present value you will need to find out, and this is where we are going to do that. So here we will need the present value of the explicit period. So this is basically until 2044, and the present value of the terminal value, right? The value which we found out at the end of this 2024, right? So let's do that. So for this, what we'll do is we'll first link this up to the respective places. This is free cash flows, right? So I'll link it until 2024. So the first step is to find out the present value of the free cash flow of the explicit period, that is the explicit forecast period. Okay, so here the present value can be easily found using this NPV formula, net present value. This will be bracket open, and what's the rate? The discount rate is nothing but your weighted average cost of capital. Okay, so this is 9.31 comma, and all the values here. Okay, so that's what I'm giving. I'll just select all the values, right? And what we'll get here is 26866.6. Okay, so this is the present value of the explicit period. Now let's find out for the terminal value as well. So when it comes to terminal value, we'll have to provide the cash flows as 0 until this terminal year, that is 2043, and then we have the final terminal value, which comes as 121,106.3. Okay, so once we have these free cash flows written in this format, we can find out the present value, right? And then we'll use the same formula, NPV, net present value. The rate is 9.31 comma, and then we can select all these cash flows to find out the net present value of the terminal value. Okay, now we will come to the discounted cash flows, and subsequently we'll be doing the sensitivity analysis. Okay, so Valuation of the company is basically a sum total of these two. First, we have the present value of explicit period, right? And the present value of the terminal value. So when you add these two up, we get the enterprise value, the value of the full firm. Okay. And we have to ultimately come and do some adjustments to find the final equity value. So this enterprise value is both to the debt holders as well as the equity holders, right? So we have to reduce the value that accrues to the debt holders. Okay, so that's what we are going to do here. And then we add cash, because who owns the cash at the end of the day? So the cash is basically accrues to the shareholders, right? So that's why cash is added here and debt is reduced. Okay, so let me do that. I'll link the debt numbers also. I think he had been provided with the debt numbers as well. So let's do that. Debt is minus 10700, because that's a total number. Okay, and I'm reducing that from the enterprise value to get the equity value. Okay, so this is your equity value. That is a value for all the shareholders, right? Now I would like to find out what is the share price per share, right? So that will be nothing but your total equity value divided by the total number of shares outstanding. So if you scroll up, you will have that shares outstanding number as well. That is 185.7. So this number comes out to be 224.5. Now, this is nothing but the fair price of the stock, right? This is 224.5. And if you compare this with the actual listed price, the listed price is 152.0. So you will give a buy recommendation on the stock, right? Now, the thing is that when it comes to sensitivity analysis, what we are trying to do is that we are trying to assess if the share price is sensitive to certain variables or not. And it is actually when it comes to discounted cash flows. Like, for example, when you look at WACC and growth rate, these are the two variables on which your share price will be super dependent. Let's say from 9.31%, I'll just make this as 12%, for example. Do you want to see what impact will there be on the share price? Let me do that. Okay. So when I put this as 12%, what do you find? You find that the share price now is 131.7. So earlier, when you saw that the market price was 152, you suggested a buy, right? Because you were getting 224. But now, when the WACC changes to 12%, you see that, oh, it's a sell, right? So it's highly sensitive, right? Now, likewise, I'll just roll it back. And let's say if I change this terminal growth rate numbers, maybe from 2.5% to maybe 0.5%. Let's see what happens. Okay. What do you see? It's 197.9, right? So it has reduced a lot. So what I'm trying to say is that these two variables, WACC and terminal growth rate, have massive impact in the combination of two on the share price. Okay. And that's why we use sensitivity analysis in the financial model. So like the way I did was, I changed the numbers manually, right? But what happens is that when you are sharing your final analysis to your client may not want to kind of, just tweak this manually again and again and, kind of do the iteration to figure out what the final share price would be like. Sometimes what happens is your client may not agree with the assumptions that you have used. Like in the case here, I have used 9.31. Maybe your client wants to go a bit more aggressive and doesn't want to discount at 9.31. Maybe he wants to do it for 11%. Now, obviously you want to save your client's time, right? So that's where this thing called as sensitivity analysis comes into picture. And it's super easy to create because it's one single table which will give you all the details of how the share price will move when there are different set of variables. So this is nothing but your two-dimensional data table where you have two assumptions here. One is the WACC assumption. So let me start from 7%, 8%. Let's make this as 9%, 10%, 11%, right? So what will happen when the WACC changes from 7% to 11%? On the other side, I have it from 2.5 going downwards to 1.1, 1.5% and going upwards to 3.5%. So the values here in between that we will get as an output will be the share price as per the assumption. So let's do that first and you will figure out how it works. Okay. So the first step to creating this sensitivity analysis is basically to mark this cell here. Okay. Let me highlight this in green. And the first step is that you link it to the final output. Here, what is the final output? The final output is the share price, right? So that's what I'm linking it to 24.5. So we are telling Excel that this is my output. Okay. Now, obviously, I want Excel to do all the iterations on the calculations in the backdrop for all these growth rates, right? So that's what Excel will do. But in order to initiate that, what I will have to first do now is select all this, okay? Then go to data, right? Here you will have what if analysis, okay? Click on what if analysis and there are three options here. I would like you to click on data tables, okay? Click on data tables and you will have two things mentioned here: row input cells and column input cells. Okay, so I've seen students getting confused as to what is a row input and what is a column input. So it all depends on how you have created this table here. In this table, we have WACC numbers as a row input. Think of it like row number 68. We have put all these numbers as WACC. Okay, so we need to put the input cell here. So what we do is we click here, right? I'll just click here and see what happens. Okay, and then it allows me to select that specific cell. So I'm not going to select anything inputs from here, but I'll go to the original inputs where WACC is actually calculated. So here we have this as 9.31, right? So this is my row input, okay? Select the original place, okay? Right? Now coming the column input. What's the column input? Column input is the thing where columns are mentioned, right? D column. And in the D column, I have growth rates, right? So we're talking about this as terminal growth rate. And what I'll do now is I'll just click here, okay? And where is my terminal growth rate? My terminal growth rate is here, 2.5%. So I select this, okay? So with these two selected, what I would need to do next is just press OK. And when you do that, what do you see? You see that there is this final output that comes as a table, right? And you didn't have to actually calculate. What are these, by the way? These are nothing but your fair price at different assumptions. So let's say if this was 9% and 2.5% growth rate, the fair value will come out to be 241.1. Likewise, if WACC was 11% and growth rate was 3.5%, you could have got 167.9 as your fair value. If you want to validate, you can also do that here. So let me just quickly change this 9% to exact number like 9.31%. So what I'll do is I'll copy and paste this value. And what do you see? Here, the intersection point of 2.5% and 9.31%, what do you see this number as? This number comes out to be 224.5, and this is exactly the same as what we got as share price, right? Now, this sensitivity analysis table becomes super important because when you go on this side towards, this side, what do you see? You see that you are reducing WACC, right? And you're reducing the growth rates. When you go on this side, you are increasing WACC and reducing growth rates. But when you go on this side here, right, the leftmost corner, these are the most aggressive assumptions. You're reducing WACC and you're increasing your terminal growth rate. So what do we note here is that the fair price that comes out is the highest, 483.7. And similarly, when we go diagonally opposite to this, where WACC is highest and growth rate is the lowest, we see that the fair price comes out to be 151.1, right? So this is the lowest among this table of assumptions, right? So this is how you can basically use sensitivity analysis in financial modeling. And it is super interesting and easy for the client also to have a look at this table and figure out where their assumptions lie and to take the call of buy or sell on that specific stock accordingly. So this brings us to the end of this tutorial on sensitivity analysis in financial modeling. I hope this video gave you a clear understanding of how small changes in assumptions like the growth rate and WACC can have a significant impact on companies' valuations and its outcomes. It's a very powerful tool, by the way. And if you want to learn financial modeling and valuation professionally, then we do provide various types of courses on that, and one of them being financial modeling and valuation. And this is basically a 25-hour of self-study course where we teach you how to create a full-scale financial model of McDonald's. And then we also discuss about discounted cash flows and relative valuation, how it can be done professionally. So it's a very amazing course, especially for those who are wanting to create a career in investment banking or equity research, or be want to become a financial analyst. This actual course is for them. So I hope you found this video insightful. Please do hit the like button and subscribe to the channel for more in-depth financial modeling content. We're just getting started with many exciting topics ahead. And also do not forget to turn on the notification bell so that you'll be the first one to know when we upload it. Thanks for watching, and I'll see you in the next video.